If you're a Singapore investor searching for steady passive income, the kind of copy money that drops into your account quarter after quarter, you've probably looked at REITs before. But what if you could tap into Asia's biggest REIT markets using just one ETF? Today, we're breaking down the Amova-StraitsTrading Asia Japan REIT Index ETF, ticker CFA, and most importantly, is CFA Asia's best REIT ETF for passive income in 2025? Stay with me till the very end, because we'll cover what CFA actually invests in, how REITs and REIT ETFs work, CFA's past performance, how potential Fed rate cuts may impact CFA, the key advantages and risks, and a simple apple-to-apple comparison versus Lion-Phillip S-REIT ETF. If you find this helpful, like this video and subscribe to Wealth for You. It really helps more Singaporeans discover content on dividend income and smart wealth building. Before we start, a quick but important note. This video is for education and general information only, not financial advice, not a recommendation. Always do your own research and consider your own financial situation before investing. Chapter 1. What is a REIT and what is a REIT ETF? To evaluate whether CFA is the best REIT ETF for passive income, let's get clear on the foundation. What's a REIT? A real estate investment trust owns income-producing properties, offices, malls, logistics warehouses, hotels, data centers. The rent collected gets distributed as dividends. This is why many Singaporeans call REITs the copy money machine. What's a REIT ETF? A REIT ETF bundles many REITs into one diversified basket. Instead of picking 10 or 20 REITs yourself, you buy one ticker and instantly own a wide portfolio of properties. So, if your goal is passive income with diversification, a REIT ETF like CFA becomes very attractive. Chapter 2. What exactly is Amova REIT ETF or CFA? CFA tracks the FTSE EPRA Nareit Asia Japan REITs 10% capped index, which simply means you get instant diversification across multiple Asian property markets with no single REIT taking up more than 10% of the portfolio. Inside CFA, you'll find Asia's major REIT players: Ascendas REIT at around 10%, CICT at about 10%, Link REIT from Hong Kong also close to 10%, Embassy Office Parks REIT from India at roughly 6%, and MIT, Keppel DC REIT MLT at about 5% each. If CFA were a plate of economic rice, these would be the standard items: egg, vegetables, meat, a simple but well-balanced mix. Here's how CFA spreads its exposure. Singapore at about 68%, Hong Kong at roughly 13%, India at 8%, Malaysia at 5%, and others in small portions. So CFA is mainly Singapore REITs for stability, topped up with regional REITs for diversification. Chapter 3. Does CFA actually deliver passive income? To judge CFA as a passive income tool, we look at its financial year 2025 results. Over the past 1 year, CFA returned positive 11.48%, a strong rebound as Asia's REIT markets recovered. But the longer view is softer. Negative 3.24% annualized over 3 years and negative 1.36% over 5, reflecting higher borrowing costs and weaker Hong Kong REITs during the rate hike cycle. Since its 2017 launch, CFA still posts a modest positive 1.84% annualized return. Not exciting, but steady for an income-focused ETF. On the income front, CFA paid about 4.46 cents per unit across 4 payouts in FY25, which works out to a trailing yield of roughly 5.3%. based on 17th November 2025's closing price of 83.7 cents. It's not the highest-yielding REIT ETF, but it is consistent and diversified, which is valuable if you prioritize predictable passive income. Think of CFA like a cup of kopi C, not the strongest, but reliably smooth, especially useful when markets turn shaky. Chapter 4. CFA versus Lion-Phillip S-REIT ETF. To see whether CFA could be Asia's best income ETF, it helps to compare it with a familiar option, the Lion-Phillip S-REIT ETF. Both are built for passive income, but their approaches differ. CFA invests across Asia ex-Japan, Singapore, Hong Kong, India, Malaysia, South Korea, giving wider diversification. Lion-Phillip stays 100% in Singapore REITs, focusing purely on local stability. Because of this, CFA usually delivers moderate yield with regional and currency risks, while Lion-Phillip typically offers higher yield and lower volatility. In short, Lion-Phillip means higher yield plus pure Singapore stability, while CFA gives you diversification along with Asia growth exposure. Which matters more for passive income in 2025, stability or broader Asia exposure? That's what the next chapters explore. Chapter 5. Why this matters for CFA's passive income. To assess whether CFA could be one of Asia's best passive income ETFs in 2025, we need to look at a key driver of REIT performance: interest rates. When the Fed cuts rates, three things typically happen. Borrowing costs fall, giving REITs more distributable income. Yield spreads improve, attracting investors back into the sector. And property values tend to stabilize or recover, lifting NAV. This matters for CFA because about 68% of its portfolio is made up of Singapore REITs, and Singapore REITs historically benefit strongly from falling rates. Hong Kong and India REITs may recover at different speeds, but overall, a Fed cutting cycle is a clear tailwind. So, if rates ease in 2025 to 2026, both CFA's performance and potentially its distributions could improve, strengthening its case as a leading Asia REIT ETF for passive income. Chapter 6. Why CFA stands out for income investors. CFA brings together several strengths that make investors consider it a contender for Asia's top REIT ETF. First, it offers Asia-wide diversification in a single ETF, giving you exposure to multiple property markets instead of relying solely on Singapore. It also pays quarterly income, which fits naturally with how many Singaporeans plan their cash flow. Because CFA uses full replication, you're holding the real underlying REITs, not synthetic substitutes, giving clarity and transparency in what you own. And unlike SGX-listed options alone, CFA provides access to India and Hong Kong REITs that most investors can't easily buy directly. Finally, if Asia's property markets rebound, especially India's office space or Hong Kong's retail sector, CFA stands to benefit. For income-focused investors seeking a mix of stability and regional opportunity, these advantages make CFA a compelling option. Chapter 7. The risks you should know before buying CFA. While CFA has its strengths, it also carries risks that may not suit every income investor. REITs are cyclical, so rent cuts, weaker occupancy, or a recession can quickly reduce payouts. Because CFA invests across Asia, your returns also move with foreign currencies like Hong Kong dollars, Indian rupees, and Malaysian ringgit, adding another layer of uncertainty. Its yield isn't the highest, as the ETF trades maximum income for broader diversification. And markets like Hong Kong and India can be volatile, which means more short-term ups and downs. Add to that the weaker 3 to 5 year performance, and it's understandable why some conservative investors may prefer the stability of something like Lion-Phillip. These are important considerations before deciding if CFA fits your passive income strategy. Chapter 8. Who is CFA really for? CFA works best for investors who already hold Singapore REITs and want to expand into regional markets without the hassle of buying overseas counters. If you believe Asia's REIT markets will strengthen as interest rates fall, and you prefer simple quarterly passive income without stock picking, CFA fits naturally into that strategy. But it may not suit those who want maximum yield, dislike currency risk, or prefer the pure stability of Singapore-only REITs. Understanding this balance helps you see where CFA truly shines, and where it may not. Final verdict. Is CFA Asia's best REIT ETF for passive income in 2025? So, after everything we've seen, let's answer the big question. Is CFA the best REIT ETF in Asia for passive income? If your goal is maximum yield, then the answer is no. Singapore-focused options like Lion-Phillip may suit you better. But if you value diversified income, meaningful regional exposure, and the potential upside from Asia's REIT markets as rates fall, then CFA becomes a very strong contender. To me, CFA isn't the strongest copy on the menu, but it's the smoothest blend of Singapore's stability and Asia's growth potential. A balanced, steady option for long-term passive income investors. Used well, CFA can be a regional income building block, a reliable quarterly payout source, and a solid diversifier for Singapore-heavy portfolios. If this helped you understand CFA better, like this video so more Singaporeans can build a cash flow-rich future, and subscribe to Wealth for You for more income investing guides. This is Wealth for You, helping you build a retirement you don't need a holiday from.